If you are a teen thinking about AI stocks in 2026, here's the trap. You buy after the pop, panic sell on the dip, then blame bad luck. Here's the plan: build a diversified base, add an optional small AI slice, and use rules that keep emotions from making decisions for you. If you would not hold it for 3 years, do not buy it for 3 days. Here's the story I keep seeing. Someone sees AI as the future everywhere, picks a random AI stock, buys because it feels like everyone else is getting rich. Then the stock drops 15% on earnings or some headline, and they bail. A couple months later, it rebounds, and they are left thinking the market is rigged. It is not rigged. They just did not have a system. Also, quick maturity check. This is education, not financial advice. Stocks and ETFs can go down, and you can lose money, especially with high-growth themes. If you are under 18, you will usually need a parent guardian involved for a real account. So use this to learn and to talk through a plan at home. AI investing basics. What you are actually buying, ETFs versus individual stocks. When people say, invest in AI, it sounds like one thing. It is not. AI exposure can mean totally different businesses. So before we even talk ETFs versus single stocks, here's the quick map. AI exposure usually falls into 4 buckets: chips and hardware, cloud and data centers, software and tools, and end-user companies applying AI in their products. And here is why that matters. 2 companies can both get labeled AI and still behave completely differently. For example, a chip supplier can be doing great because demand is strong, while an AI app company struggles because customers will not pay enough or competition is crushing prices. Same AI label, totally different business. Now, how do you invest in this stuff? You have basically got 2 routes. Route 1 is index funds or broad ETFs. That is the basket approach. You own a lot of companies across the market. It is usually calmer, less work, and it avoids the one company ruined my whole year problem. Investor. Gov talks about diversification as a basic way to reduce risk by spreading your investments across many assets instead of relying on one outcome. Route 2 is individual AI stocks. That is the single bet approach. The upside can be bigger, but the downside can hit you fast. And you have to be right not just about the company, but about expectations, timing, and hype. For teams, the big advantage is not having some secret pick. It is time and consistency. You do not need to swing for the fences to win long term. What AI boom 2026 could mean, without predicting prices. Let's cash the 2026 part without doing fake predictions. An AI boom in 2026 can mean a few real-world things that affect stocks, even if the technology keeps improving. 1. Regulation and headlines can swing sentiment fast: privacy rules, AI safety rules, copyright fights, and who is allowed to use what data. 2. Earnings expectations can get stretched. If a company is priced like perfection, even good results can lead to a sell-off. 3. CapEx cycles matter. If companies spend huge on data centers and chips, the market will watch whether that spending turns into profit or just bigger bills. 4. Competition can compress margins. AI tools can become normal. And when something becomes normal, the hype premium can fade. So 2026 does not mean buy now and guaranteed moon. It means the environment might be loud, fast, and emotional, and your plan has to survive that. The real risks: volatility, hype. FOMO risk number 1 is volatility. AI-related stocks can swing hard because they often carry big expectations. A company can be solid and still drop a lot if the market decides it was priced too high. That is not just bad luck. That is how high expectation stocks behave. Risk number 2 is hype cycles. New tech tends to move in waves: excitement, then overexcitement, then reality checks, then a slower phase where the real winners keep building while the hype names fade. If you buy during the loudest moment, you are paying for optimism, and optimism is not always stable. Risk number 3 is FOMO. This is the one that gets people the most, because it feels like everyone else is early and you are late. But most of what you see online is highlight reels. People post wins. They do not post the part where they bought the top and sold the bottom. So here is a clean mindset shift. If your reason to buy is mostly social, it is trending, or everyone is in it, you are not investing, you are chasing. And chasing usually ends with you buying high and selling low. One line to remember: a good company is not automatically a safe stock. The teen-friendly plan: diversified base plus small AI slice, plus simple rules. Now for the plan that actually works for most teens. Build a diversified base first, then add a small AI slice if you want. This is how you get exposure to growth without your account turning into a stress machine. Your base is broad. Diversified funds think own a big chunk of the market, not bet the whole account on one theme. Your AI slice is optional, smaller on purpose, and controlled by rules. Here's a simple example structure you can understand in 5 seconds. 80 to 95% base and 5 to 20% AI max. If you want to be extra safe, keep it closer to the low end. The point is simple. Your AI slice should never be big enough to wreck your future. And one crucial caution: an ETF reduces single company risk, but a theme ETF can still drop hard because it might be concentrated in one sector and it might overlap heavily with mega cap tech. So ETF does not automatically mean safe. It usually means spread out, and the details matter. Now, if you are the type who insists on individual stocks, I'm not going to act like that is illegal. But you need a framework. Here is a compact checklist you can run in 2 minutes before you buy anything. First, what does this company actually sell? Chips, cloud, software tools, or an end product? Second, how does it make money today versus future promises? Third, what would prove you wrong? Like, what headline or business change would make you say, okay, my original idea was wrong? Fourth, are you buying growth or hype? Growth has numbers behind it. Hype has vibes behind it. Fifth, how concentrated is your exposure? If one stock or one theme is most of your money, you do not have a portfolio, you have a single bet. Now let's make this easy to follow with a simple scoreboard. If you do nothing else, do these 3 habits. First, automate your investing. Weekly or monthly, even small amounts. This helps you stop trying to time every headline. Second, cap your AI exposure. Literally write down your max percentage and stick to it. Third, cool off before you buy or sell, give it 24 hours. That 1-day pause saves people from a ton of emotional trades. If you want the extra habits, I will put them in a template you can copy. Check your portfolio. Let's keep a 1-paragraph why I bought this note, and only take bigger bets after you have proven you can be consistent with the basics. And one more teen-specific note. If you hear people talking about Roth IRAs, that usually requires earned income money you made from a job, so it is not always available right away. The IRS explains Roth IRA rules and contribution limits in their guidance. So here is the whole message. AI in 2026 can be real and messy at the same time. The tech can keep improving while stocks still swing like crazy, because expectations, headlines, and competition move fast. Your job is not to predict the next chart. Your job is to build a setup that keeps you investing no matter what the news does next week. Diversified base first. Small AI slice second. Rules always.